ladies and gentlemen, our first panel post-lunch is on new avenues for capital, secondaries, and private credit. I'd like you to please welcome our moderator for this session, Mayur Gala, partner, Price Waterhouse & Co. LLP. Mayur has more than 15 years of experience in advising ARCs, NBFCs, private equity, venture capital funds, real estate funds, capital market groups on domestic and international transactions for doing business in India as well as local tax and regulatory compliance matters. ARC and NBFC sectors are his area of expertise. Let's put our hands together as we welcome him to the stage, ladies and gentlemen. Welcome, sir. Let's welcome Amit Agarwal, President and Head, Private Credit, Edelweiss Alternatives. Amit is one of the founding members of the private credit business at Edelweiss and currently has direct oversight of $4.5 billion of assets across performing credit, real estate credit, and special situations fund. He has 2 decades of experience in private credit and special situation finance, corporate finance, turnaround management, and acquisition financing. A round of applause, ladies and gentlemen, please, for Amit Agarwal. Bharti Agarwal, Principal TPG. Bharti is with the investment team at TPG Newquest, based out of Singapore. She has been part of deals totaling over $1 billion in capital deployed across over 20 companies, with a focus on consumer and technology. Her geographic coverage includes the APAC region, with a thrust on India and SEA. Our next panelist is Kapil Singhal, Managing Partner, Private Credit, True North. Kapil joined True North in 2021 and is responsible for establishing a best-in-class credit platform for investing in private credit for True North. He has 25 years of investing experience in credit in a variety of roles encompassing origination, structuring, trading, and fund management. Prior to joining True North, he was the head of India Credit at KKR. And in his recent roles, he also co-headed the Edelweiss Special Opportunities Fund and ran the India Trading Desk at Goldman Sachs. A round of applause, please, for Mr. Singhal. And our final panelist this afternoon is Norbert Fernandes, Director, TR Capital. Prior to joining TR Capital, Mr. Fernandes was principal at Ivy Cap Ventures. Before that, he worked at Temasek Holdings in Singapore and Mumbai, and he was an early member of the India investment team. Handing it over to the panel. Before you take the stage, I'd just like to announce that we have a breakout room as well. There's another session happening in breakout room B. It's on pushing the tech frontiers, the growing role of Gen AI. So over to you.
Yes. So I think it's going to be a difficult session for us, or maybe with you all. Post-lunch, we're all here. All of you all would have kind of thought through or at least heard the concept. I was speaking to many of you pre-lunch as well about, the concept secondaries, private credit. I think that's what we're going to talk about. And, with this esteemed panel on the stage here, all of you all would have heard them, across several other panels as well in the past. So I think the idea is, what you're thinking about is to kind of go, given the wider set of the crowd, going to the concept about what these 2 aspects, involve, these 2 themes, and then going a little bit more detailing around, what is really going these segments and what is it that we can look at, going down the line as, we look at these trends going further. So without wasting too much time, maybe, we can initiate the concept of secondaries. Secondaries as a concept is not something that all of us understand. We've all heard about it. We all know a little bit about it, in terms of what is it, how does it function, but I'm not sure. Even I myself, when we were speaking to Bharti earlier, we were trying to understand the granularities, and Norbert mentioned to me that there are a lot of nuances around how it is globally in Asia and India. So maybe I would want to put the first question to Bharti. Bharti, you spend so much of your time across different segments, including the consulting part, and you've been seeing the Asian segment, the global as well as India. So what will be useful is if you can just lay down the concept of secondaries itself. What does it really mean? And how if someone has to understand as a layman, in terms of secondaries, how would you really try and put it?
No, thanks, Mayur, and thanks to Nopur and the WinPE team for this opportunity, but also for such a fabulous event. So secondaries, I think, firstly, the headline statement would be we solve for most GPs' biggest pain point, which is exits. Secondaries has many kind of forms and structures it takes, and when we think about secondaries, we probably think about three kind of sub-asset classes almost within that. The first is what we call direct secondaries. This is often the most simple type of secondary transactions. Often this is just one GP buying from another GP, and the GP who sells exiting completely. The second type of transaction that we are seeing increasingly more of globally and in Asia is what we call GP-led secondaries. So this is, a set of assets moving from one fund structure to another, with LPs in the original fund structure getting liquidity. However, GPs typically continuing to manage those assets in the GP secondary construct. It can involve one asset, multiple assets. It could be, the entire fund closing down, changing hands. It could be a strip sale. There's many kind of permutations to that. But this is a very interesting and evolving kind of asset class that we're seeing. And I think the third piece that we often include in secondary transactions is LP to LP secondary, where it doesn't really touch the fund level, but it's just one LP selling to another. Mayur, since you asked, I do want to just take a minute to kind of a few seconds to reflect on how large this asset class has become. We tracked this data quite closely, but last year there was $170 billion in secondary transactions that happened. The largest secondary funds in the world are now 20 billion plus. So this asset class is really sort of exploding. GP-led secondaries is growing at about a 19% CAGR globally for a 5-year basis. So we are seeing a lot of kind of exits being the problem in a lot of these solutions coming to market. On the second, in the piece around Asia, what we are seeing is Asia still remains very under-indexed on the secondary transaction bucket. So, for overall private equity, typically 20% of deployment goes to Asia, whereas for secondary transactions, that number is as low as 6%. So it seems like there's a lot of opportunity in Asia. There's about 1.3 trillion in unexited capital that remains. So yeah, there should be enough and more happening with more interesting transaction constructs, we think, in secondaries.
Thanks, Bharti. Moving to about, if you would want to kind of add, your perspective on secondaries. You're here on the ground. You spent fair bit of time around secondaries, and we've seen a lot of work that you've yourself done. If you would want to just give a context, specifically from an Indian perspective, would it be similar as to what we're seeing globally, or is there a
Sure. Happy to give a little bit specifics on in how it's going in India. So if I were to sum it up, I would say that secondaries in India, it's coming of age now. So in more developed markets, like Bharti mentioned, this is a well-known asset class. Secondaries have been around for a while. But in Asia in general and India specifically, this is somewhat of a newer animal. And maybe just the last 5 years, maybe 7 years, it's something which people have started to understand what value it brings to the table. And why is that? Why is it happening right now in India? That's a whole discussion in itself, but a few broad pointers. One is, when does secondary start making sense as a solution for exits? A few factors need to line up. One is, there needs to be a history of fund managers having raised capital and deploying that capital, and that has been happening at a healthy clip in India for decades now. So that builds the asset class of PEVC. But when you start reaching a point where there's a critical mass of unexited positions, and then there is an exit pressure which is coming up, which is not being met by, say, the traditional exit routes of IPOs and M&As, and then there's a gap there. When that gap becomes meaningfully large, that's when secondaries take off in a country or in a geography. And that's why I say that it's lining up for India right now, that this asset class has become meaningful. So I think people have started taking attention of this fact, and there are enough pools of capital who are dedicating themselves to a secondary strategy. That's what's happening on the ground, really. For the moment, I think there's a lot of opportunity for funds like us. There's a very healthy pipeline of positions that GPs need to exit, or funds that need to deliver liquidity to LPs. So for the moment, I think it's definitely a little bit the power is a little bit with the secondary funds right now, but that is going to change. More pools of capital will get attracted to any opportunity. That's just how it goes. And I really think that over the next 5-10 years, this is going to be a very open playing field, and there will be a lot more players. It will be a very liquid market.
Thanks, Norbert. I think that's worth looking at in terms of how it's going to move. Moving on to the second theme, just to kind of kickstart private credit. I think all of us understand, unlike secondaries, private credit is a concept that is understood. However, private credit by itself is a term which is very, very wide. It has a huge buckets within the concept itself, and usually kind of when it started with the banks not being able to kind of cater to a segment, that's where a private form of lending or a credit mechanism started. So I was reading, Amit, you mentioned in another session earlier that India has lent credit of more than 200 lakh crores, and private credit is still less than 1% of that. So if we really look at it, and if it's just less than 1%, then that basically means there's a way ahead in terms of where it can go to. So maybe over to you, Amit. If you can just share your perspective around what is the nuance within private credit, what are the layers, what are the themes, whether it is return mechanism, whether it is, how would someone really look at private credit? Because the concept itself is so large.
No, I think private credit is a lot more boring than secondaries, I guess, because it's just about money lending. Because in the sense, not money lending in the sense that by giving capital to clients, which is more a flexible solution. So private credit is all credit that is outside of the bank credit. And bank credit has a specific way in which it is done, while private credit is a lot more flexible. And percentages can be misleading, but even at 1%, the market size is fairly, very large at this point of time in private credit. So I think for us, the private credit has opened up a lot of avenues for a lot of entrepreneurs. I think which is where the banks like established companies, they like very established business models, they like to see a lot of EBITDA generation or proof of concept before they actually enter. While private credit has buckets which can actually fuel a lot of these things. So for example, venture debt as a category is a part of private credit, where you can actually lend to companies which are either looking at some bridge to next equity round, or they are doing some capital raise to ensure that their business flourishes. So it could also be in form of primary financing, where let's say a company is doing a buyout of its own private equity partner and needs capital which is more equity type than actually a credit. So those are the things which can come into the performing credit bucket. And then as Norbert was speaking about exits, I thought I was reminded of my special situations, because at the end of the day, what special situations does is when a bank has got stuck with its position which is not getting exited in the normal course, that is where special situation picks up some of those assets. So we would buy some assets off the existing lender at a discount and then basically turn around the company to do a special situation. So you have venture debt, early stage money, you have performing credit, good quality companies looking at stake enhancements, growth capex. You have special situation where you're giving exit to existing lenders or refinancing certain positions. And you could also have structures like pure core credit, or basically where you lend like any other bank, but you are lending maybe a little more LTV, or you're lending a little bit more in terms of actual amount. So it's a spectrum, and it ranges from a return from all over 12% to all 20% plus. And I think like any old thing, more return, more the risk sort of situation. But I think that is where the key art is of doing private credit, is to try and maximize your yields without increasing on the risk vector. So if you're able to achieve the more risk-adjusted return you are able to achieve, the better your outcome in private credit. So, and a lot of people ask us what's the market, because we've been in this market since 2012. And people ask, in India, when you lend money, do you get your money back? I said, the economy won't be working if people are not giving money back. But we have now funds which are large-sized funds, like 10,000 crore plus funds, who have returned their capital, returned the yield to the clients, and which is a very big proof of concept. The only one thing I would like to add, and then I'll leave it, is that the key change in private credit market has come post the bankruptcy code. Because prior to 2012-13, we all were in the same market, and it didn't used to be any, nobody used to call us on any panel in 2012 for sure. But it's been a long 20-year journey, of which last 3 years we are visiting some panels. But the point is that credit at that point of time did not have teeth. So if a borrower was actually biting into you and was not delivering you your money back, then you had nothing to do how to get the money back. With bankruptcy code, that has sort of changed. Now you can read reports that this is not happening, that is not happening, but that is India for you. You have to deal with the volatility. But the creditors now have substantially better rights, and that is why private credit market, which used to deliver $500 million odd of deals every year, is now doing almost $7.5 billion of deals per annum. So the market has grown, the visibility of the market has grown, the players have become larger, and that's what is driving some of this.
Thanks, Amit. I think well summarized and well put up. Moving on to Kapil. You leading your institution, on a fund that you've just raised. It will be good, for us to hear your perspective around how's the deal flow in the private credit space. What are the kind of returns? When you talk to domestic LPs and the foreign LPs, what's the difference? How are these trends kind of moving, as of today when you are on the ground, in terms of the deal flow?
So Mayur, I'll give you a little bit of a historical perspective as well on deal flow. So there are principally 3 categories in private credit. One is distress, combined with special situations. Second is performing credit, which is a very wide-ranging category, starting at 12%, ending at 17-18%. It's got a bunch of, we will not have time to cover the entire category. So that's the second category. And the third category is an evolving category called venture debt. Now, if you look at the deal flows in all the 3 categories, the earliest category to receive deal flow in the alternative investment format was the distress category, coming out of a large NPA creation in 2015. And immediately thereon, there was 2016, which was the bankruptcy code. And my colleague and ex-colleague and my industry veteran here got the biggest benefit of it. Of course, he did well. And they created $1.5 billion, fund out of it, and I think 40,000 crores of ARC business out of it. So that is a very substantial business and substantial opportunity. And India has seen the maximum deal flow in the distress post 2015. Obviously, the biggest change, as Amit put, was the bankruptcy code. I mean, there are many critics of bankruptcy code. Personally, me, Amit, everybody will also be. But the fact is, it has changed the way India lent and recovers. It has changed the borrower behavior. So that's number one. My belief is that deal flow is ebbing on the larger side, larger ticket sizes, but it is converting into special sit. It is converting into people have understood this asset class and they're able to deliver deals quickly. So even the smaller deals are starting to make sense. So that's the change happening. But there is a second, third tier level of distress which continues to remain. A lot of assets needs to be resolved. It continues to be strong. But the larger, the big 12 cases got resolved, and so that part is over. There's a second category, which I call as the evergreen category, which is the performing category, performing credit. It's a large category. Initially, the category evolved because of banking restrictions. And if you ask me, who's to say that NBFC credit is not private credit? I would call NBFC is also private credit. It's regulated in many ways. So NBFC took that flow post 2015, when the banks were struggling on the performing credit side, and the largest wholesale books were built after 2015. So that saw the maximum flow. So from 2015 to 2018-19, the wholesale NBFC books bulged. And then came the NBFC crisis. So that's the story. If you look at the way India has evolved and the way it lent, and then that ebbed because then the IL&FS happened. It's a long story, everybody knows that story. So that flow was then taken up by funds like ourselves. Edelweiss had a performing credit fund. A bunch of funds started mushrooming on the performing credit side, taking up non-distressed structural limitations of banks, which was taken up by NBFCs, and that started building out. That time, the deal flow, to your question on deal flow, most of the deal flow was refinancing. India was still not seeing a lot of capex cycle growth, etc. And that continued, the deal flow in terms of refinancing continued till about last 1.5 years. It continues still. So there's almost a 40-50 billion dollar of good assets sitting in either banks, NBFCs, or mutual funds, which are getting refinanced out. Then the third, crisis happened, which is all these crises are an opportunity for people like us, which is the mutual fund crisis. And then a lot of that, deals are getting. Coming to where we are today in terms of deal flow. So I believe the refinancing deal flow is, going out. It's receding. What used to be 75-80% of refinancing market is coming down to more like a 50%, less than 50%. But, there's always something else which is going to take place. And, the way we are set up today, we're just fortunate that, we are today in an economy which is going to grow at 7% plus minimum on GDP. There are so many sectors which are, showing tailwinds that CapEx cycle seems to be now firmly in place. I don't talk from, macro numbers. I talk from what we see on the ground. Out of what, 20 deals that we see today, which is there on our pipeline, at least 7-8 deals are CapEx-led. Today, CapEx are largely brownfield, which is good for us because it is lower risk. But I'm sure sooner or later it'll become greenfield, it'll become new location, new businesses. I think it's starting to happen. So that's the deal flow. I guess, we remain extremely bullish on the opportunity. We believe private credit market today is at a stage where private equity was 20 years back in terms of alternative investment funds. So there will be a few missteps. There will be pressure on pricing. We will make a few mistakes. But I do believe, looking at our industry veterans, we are well connected as a industry. I think by and large, the people who are managing this industry are well experienced. They are from the same cohort. We talk to each other a lot. I think the mistakes are going to be lower.
True.
So extremely bullish, overall on the private equity, private credit industry.
Thanks, Kapil. Moving back to secondaries, Bharti, maybe I'm just mindful of time. We want to just take Q&A as well. Quick 1 minute or 30 seconds. When you look at a secondaries deal, what is it that you'll put as the checkpoints that an LP or a fund would typically want to look at?
Yeah, no, thanks, Mayur. Maybe I'll speak about, say, a portfolio GP secondary, since there is few types, right? I think firstly, obviously the asset underwriting, but also for portfolios, asset selection and mix in kind of risk reward is pretty important. The second would be GP economics. How do you structure it in a way that takes into account that all assets are not equal? Can you give upside sharing? Can you be innovative about GP economics? I think much more options there than, say, a blind pool fund GP economics design. The third would be alignment with GP in terms of exits. Say if they have the same asset from multiple funds, how they align with you on the exits. And lastly, I think where we really come to the big four all the time is just on transaction structuring. We're often buying different assets, different jurisdictions, different holdcos. So there is often more than one ways to structure it. How do you structure it in the most efficient manner? So I think those would be some of the top of mind checklists. Yeah.
That's nice and quick and very, very specific in terms of how we look at it. No, but when a fund goes in primary, and if it's a buyout fund, there's a lot of work that happens when the fund is with the portfolio. So if a secondaries come in, what is it that from a value lever perspective, how does the secondary play on on the portfolio company, on the portfolio, the pools, if you want to just share your perspective?
Understood. So what value add would a secondary fund typically look to give to portfolio? So I think like with any private equity fund, each fund defines itself a little differently. Some define themselves as extremely hands-off. Some have operating partners and are extremely hands-on. So it's also a flavor, the DNA of a fund. So I won't put very broad brush on the answer I'm about to give. But yeah, I think the value add, at least the proposition, should be dictated by typically what is the stage of the firm that you're investing in, right? And almost by definition, a secondary fund is coming in a little bit late into the life of a company, probably a few years before it is IPOable. So you think about a company at that stage, what does it need? It doesn't need us to come and tell them how to run their business, right? They know how to do it. That's how they've scaled. What they probably need is stuff like, what are the global best practices in my industry? what are firms in China doing better than us? Or can we source our raw materials and our components far more competitively from a global source, right? So those are things we try to add value on, and it helps that, and similar to NewQuest, we have a Pan-Asia focus. So we bring in whatever learnings we can from across our portfolio, including from China, to our India founders. So that's one type of value add you can bring. Another kind is a lot of these companies are at least starting to think about an IPO. It's quite frequent in our portfolio that the companies are at that stage. So we help them with all the, cleaning up and just, kind of growing up and becoming ready for IPO. There's a lot of stuff to be done. It's very process oriented. It's very regulatory and compliance in nature. It's not the stuff that, a tech founder is wowed by. He doesn't love this kind of stuff. But those are things you absolutely need to do to be in a position to list successfully in India. So we bring in that kind of capabilities also, some gray hair into the board, stuff like that, which really matter to the company at that point of their evolution. But other than that, I think it's all everybody, there are secondary funds who are extremely hands-off also, and they will not do anything. That's also a perfectly valid approach.
Understand. Coming to Kapil, private credit, we've heard about how it's originated, you mentioned, and where is it today? What's your take on the next 5 to 7 years, the private credit segment in terms of what a broad perspective, what do you think, where is it going to go? Is it the trend which as of now, or is it going to be diversely different, whether it is return expectations, whether it is structures, enforcements, any perspective?
Yeah, so maybe what I will cover it like, in a structured way is like this, that let's see what we've got today in India in terms of, how do we see the various pieces lined up. One is you got the regulatory piece lined up, which we spoke briefly. I do believe that RBI and the SEBI as a regulator are not letting up doing regulated vehicles do funkier stuff. So that part has been very clear for a long time. It continues to show up. If people who follow the AIF regulations and the NBFC regulations, RBI has been very, very strict of late, pretty activist almost in the last 3-4 months. So it's very clear that NBFC's life is not getting easier. They have to continue doing straight-jacketed things. Banks will also continue doing straight-jacketed things. Mutual funds as a business is, on the credit side, is gone down to being restricted to AAAs. So the space is pretty wide open for funds like, for private credit funds to take up this space. Now it is up to us. Do we have the bandwidth? Do we have the manpower? Do we have the capability to discover the market? I always think of this market as what is called as discovered market and what is undiscovered market. So the discovered market, people can complain that it is very small. So there is, and I'll make it a little light. If you ask how is the deal flow in a private conversation, few of the fund managers will say in a water cooler conversation, oh, there is hardly any deals. When you come and speak in these forums, we'll all say the deal flow is very high. And my answer is very simple. My answer is deal flow is very small when it comes to discovered market because there are too many funds. You can say 10, 12 funds competing on it. But look at the numbers. Amit spoke about some numbers, and I can give you a very simple number. 1.2, maybe more trillion bank balance sheet. $300 billion of NBFC balance sheet. Maybe it's receded a bit. And total private credit funds is maybe in performing credit is $3-4 billion, including all the distress that has come into India is $20-25 billion. And GDP is growing at 7% plus. Banks are not getting any quicker. NBFCs are not doing any wholesale banking. This is my belief, Mayur, that we don't even market our product properly. And if we go to tier 2, tier 3 cities, if we go and sit with the investment bankers, go and sit with people, this whole private credit market, at least the performing credit side of the market, is confused as market where you sit in your desk and wait for deals to come in. It doesn't work like this. So it's a deal-making market. You have to step out, go travel, meet people, meet your investment banking friends, and figure it out. And I think if you look at it, the minute you start doing it, the deal flow just increases. So I think that's where it is headed. People will have to evolve themselves. I think the market opportunity is huge, number one. The distress market will, as I already mentioned in the earlier comments, will evolve into a, it'll ebb and tide, it'll, peak, but special sit market will always remain. And the tier 2, tier 3 distress will continue to get resolved. Venture market is related to the VC cycle. So I think the money need is always there, but I need appetite of the fund managers will keep going up and down. So the market opportunity remains extremely strong. What is also happening is the perception of India is changing dramatically. So a lot of global pools of money will start coming in. I mean, who would have thought that there are going to be 2 or 3 near billion-dollar funds raised in India? 2 in distress and 1 in performing credit. 2 of them are managed by my colleague here, on the Edelweiss front. And we aspire to be a billion-dollar fund, at True North also in maybe like 4 years. And I think the opportunity market will support it. In terms of return expectations, there are a couple of things. For the domestic people, because of the regulatory change on the taxation front, the MLDs went out of fashion because of taxation change. Market-linked debentures was a category which used to attract very specific taxations. That I think SEBI fixed somewhere in early part of last year. Then mutual funds taxation change, and therefore AIFs today are at par in terms of taxation for domestic LPs. There are billion-dollar domestic, I mean, not exactly credit funds, but easily $500 million domestic credit funds are getting raised today. So even from a supply of capital for this kind of money, I think the market is very efficient and it's able to support. Coupled with the fact, and this is what I was thinking, why the monies are getting raised, because I think we've got a good set of asset managers. The experience which the domestic investors are seeing over the last 2.5 years is so good that they are coming back and asking for more. The demand is coming back. It is rare, in the last week, I got a call from one of the largest wealth managers to say that, can we raise money for you? I mean, it's not happened. I mean, we were always the guys chasing and, being ignored. Now it's happening the other way around. So that's the kind of, so I continue to be extremely bullish in the way we are set up today. We'll obviously need to evolve as a fund managers, as team, as our mindset in terms of origination for performing credit category.
No, absolutely, Kapil. I think clearly that's a sense that we're also kind of hearing across that what we are seeing today is just the tip, and maybe the next 5 years, 7 years, 8 years, this is going to be a established field in itself. Like the way we talk about private equity, I think private credit is going to go a different level. So Amit, moving on back to you, there's another breakout going on Gen AI, and just so that everybody gets the flavor of it, what's your take on technology, Gen AI, ESG, kind of getting embedded? We've heard private equity being fairly involved in all these things. Will private credit also, reflect upon it, and does it change, the way in which portfolios, performances, track records, various things kind of move in?
I hope my job doesn't go because of Gen AI, but I think, but at least I don't see that happening in the next 20 years, and I think that'll be about it by the time I'll retire. But at this point of time, see, technology is an enabler, and I think we as Edelweiss have been slightly ahead in curve on many things because we started quite early. And as I said, in early part of the time, we didn't have as much work to do, so we started developing technology and other things. So currently we are using technology as an enabler. Like one of the most important uses I think of AI will come in reading through the documents or a sift of documents. I think that is the first level of usage that we will see. In fact, we are collaborating with somebody where you can feed all the balance sheets in your the system, and it will give you all the important points basis your parameters. So I think the first level will be to how you augment your ability to do more deals through the generative AI module. Because I think we are still, it's a very fancy term, but I have tried to go there and see what exactly it is. I think it is still very early days at this point of time. But yes, technology as an enabler is something we should all look for because it's a very empowering tool, whether it is about data mining, whether it is about finding the companies that need your sort of capital or reading the balance sheets of those capital. Your second point was on ESG. I think ESG will become mainstream very clearly. And I think the world has started getting divided in terms of ESG also. So there are some states in US which actually don't want to hear about ESG anymore. But I think it's a reality of life that the environment is changing. All of us feel a hotter summer, a colder winter, or accidental rains. So all of that changes will at some point of time lead us to think that what are we doing for our environment. So ESG is largely being pushed top down, and I think that's how it will work, where the cost of capital for an ESG compliant company will become lesser than the cost of capital with ESG non-compliant company. In India, till there's a financial benefit, nobody moves. So I think the companies will need to have some sort of financial benefit to move in the ESG direction. The key being the cost of capital reduction on ESG. We actually have started integrating, like we are the first asset managers to sign UNPRI, which is United Nations Principle of Responsible Investing. And we are now adapting all our funds to SFDR Article 8, which actually lays down what all you will do as a part of your process to improve the ESG scores. I think given that we invest in a lot of asset-heavy companies, the ESG scores to start with are worse off. But what could be you do? And S and G are easier to achieve. So like, for example, even within Edelweiss and in our companies, we promote diversity, which is an important leg of social. We also promote sort of well-being of the employees. That's also a part of social things. Governance means policies. Environment or emissions is where the key thing is, where capital is required to change things on the emission side. I think that will also get achieved at some point of time. So I think ESG will be an enabler for the companies as well to reduce their cost of capital in the long run.
Yeah, thanks. Well put, Amit. So I think we'll move on, to the audience for Q&A. Either secondaries, private credit. If anyone has any questions, we can just take that up with the panelists.
So I just recently have gotten involved in the NBFC ecosystem, and I was just wondering about your comment. You said that there's a lot of potential for wholesale lending, as NBFCs are going more into retail, MSME impact financing sort of a route. There's a lot of just a sort of a clarification question I had for you is that when you mean by wholesale lending, are you typically talking about the 3 products that you mentioned that private credit does, or are you also talking a little bit more about traditional wholesale lending products like supply chain financing or institutional investing, or of those sorts of products as well?
So typically when we talk about private credit, although there are few funds which are managing, revenue-based financing, etc., channel financing, but that is not that prevalent a trend right now. Mostly when we talk about private credit in India, it is lending to individual companies which are, typically corporate structures, and lending against assets, lending against equity, lending against to a business, and typically lending against some collateral or security. I don't think we've yet evolved on the non-venture debt side, where we are doing, revenue-based or top-line-based kind of financing. But there are few funds, one fund I know at least in the South who's doing this revenue-based financing model. Venture debt anyway typically likes to take some part of revenue share or something because the P&Ls are not there. But largely today we are relying on EBITDAs, and largely we're relying on collaterals to, to make our life comfortable. Mayur, one comment, I think maybe you can invite some comment from Amit as well. On the fundraising internationally, how do we see, because we have time, so I thought it could be a good question.
Panelist asking panelist. Okay.
How do we see the fundraising market internationally for private credit? I think the conundrum today is global rates have gone up. Indian markets continue to remain extremely competitive. So global investors will see rates which are, if you were to compare the risk-adjusted rates, they will see India private credit fund, not delivering as much as they would like. And how do we continue to then attract capital? Edelweiss has done a magical job there. So, it's an interesting question which, Amit can, answer.
So first of all, as you said, you have to go out there. I was like on 120 days in the US and Europe for last year to get that money out. But I think, yes, you're right. I think interest rates have increased in US and Europe. So it's a little bit more difficult for Indian private credit to raise money. I think there's a big delta when you look at US funds and Indian funds. Actually, US loves leverage. By the way, performing credit in US means you are levered 1:6. And that's performing credit. By the way, even in our special sits, we are 1:5. So their performing credit is 1:6 levered. So the ROEs in US are very differentiated than ROEs here. So I think we'll have to find some solutions if we want to do credit funds globally, especially which is returning 18% sort of INR. You'll have to create a sort of levered hedged class to really reach a place with these clients because they want certainty of their dollar returns. We have raised only a special sits fund, which is a lot easier because we are anyways targeting 16 to 18 dollar, and we were able to raise $700 odd million last year. But the fact of the matter is that rates in US are also going to soften. What has not been seen, because this has been the steepest hike in interest rates ever. So the impact of that always comes with a lag effect, which is in form of credit costs. The only thing in credit which actually is of worry is credit cost. So I think since the US has not seen any credit cost, though there are large portfolios which are unexited, like she mentioned, these are 1.3 trillion of private equity. Similarly, there will be private credit portfolios. I think credit costs will lead to some sort of a readjustment or realignment. And I think India growth story is for everybody to see. So the biggest benefit that you have for a global fundraising is that there is no other place as investable as India at this point of time. 26% of upper tier population going to 53% in the next 10 years. GDP per capita going from 2,500 to 5,500. Saving habits changing completely. All of us are spending more than our parents. All the savings that we are doing, we are investing very differentiately and not into fixed deposits. So a lot of things are changing at the ground for India. So India is a bright spot. So you have to get the light shining upon for you. But as you said, you'll have to travel.
So one only comment I'll make, this is something that I constantly think as we raise in True North, the next fund, how are we going to raise international capital? One solace that we get is, Amit, I discovered, I didn't know this, that globally private credit is a floating asset class. So, in India, most of our returns are fixed. So I don't think we do a selling job of ourselves in both ways. One is what Amit said in terms of the leverage of the underlying companies, because we are truly unlevered. We have, EBITDA 3 times, 4 times. 4 times, on performing credit, our antennas go up. Whereas in the US, they are larger size companies, they're more stable, but so what? I think we have a ton of equity sitting ahead of us. I think the second is floater. And I think the third is, I think Mr. Modi or government and, the economy has just done a good job. So the risk premiums are going to reduce. What was earlier considered as, if I have to invest in India, 300 basis points, possibly now we can sell that, guys, this is what you get. You want to be in India for a longer term, you stay and come and be at par with any other global funds. So that's my take on this. So,
thank you.
No, thank you. Any quick closing points on secondaries, Bharti, Robert?
No, I was just ending on a lighter note. We are there if you have assets to exit. But yeah, look forward to seeing this asset class grow. I think a lot of opportunity. Yeah.
No, absolutely. Thank you so much, to the panel. Amit said nobody invited him to the panel until private credit became. So next round, when you see private credit grow, you'll see Amit writing a book along with
women in private credit will be
the theme. No, the theme will be secondaries in private credit.
Yes. Thank you, everyone. Thank you
Thank
so
you
much.
very much.
Thank you.
I request our panelists to please stay on stage. Ladies and gentlemen, please welcome Mr. Raj Pai, founder and managing partner, South Asia, GEF Capital Partners, to present our distinguished panelists with a token of appreciation on behalf of WinPay. And of course, ladies and gentlemen, the products that we are giving away today to our speakers have been made by women entrepreneurs, and WinPay is honored to be able to provide them with a platform to showcase their products. Ladies and gentlemen, put your hands together, please, one more time for our moderator, Mr. Mayur Gala, Mr. Amit Agarwal, Ms. Bharti Agarwal, Mr. Kapil Singhal, and Mr. Norbert Fernandez for sharing with us their insights. Thank you once again. So ladies and gentlemen, we had 2 breakout rooms. We're going to be all convening right here. So we'll give everyone in breakout room B 5 minutes to gather here, and we'll continue with our next session. Just a reminder, if you haven't already filled out your feedback forms, please do so and submit them to the registration desk. We'll continue with our next session in about 5 minutes. Thank you.